General risk disclosure. Trading financial instruments, including forex, futures, equities, commodities, and cryptocurrencies, involves significant risk of loss. Trading is not suitable for all investors, as it may result in the loss of your entire investment. Leverage, volatility, and liquidity risks are inherent in these markets. Before engaging in trading, carefully consider your financial situation, experience level, and risk tolerance. You should only invest money you can afford to lose. Forex and futures disclaimer. Trading in the forex and futures markets is highly speculative and carries a substantial risk of loss. The leverage nature of these instruments amplifies gains and losses, potentially leading to substantial financial exposure. This content complies with CFTC Rule 4.41. CFTC Rule 4.41 disclaimer. Hypothetical or simulated performance results have certain inherent limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Equities and commodities disclaimer. Equity and commodity trading involves risks associated with market volatility, company-specific factors, and geopolitical events. While stocks and commodities may have a lower leverage factor compared to forex or futures, they can still result in substantial financial losses. Cryptocurrency disclaimer. Cryptocurrencies are speculative and highly volatile instruments. Trading cryptocurrencies involves additional risks, including regulatory uncertainties, security vulnerabilities, and lack of liquidity. Cryptocurrencies are not regulated by most governments or central banks, and their value may be affected by external factors such as news events and market sentiment. Regulatory references. In the United States, this content adheres to the regulatory standards of the Commodity Futures Trading Commission, National Futures Association, and Securities and Exchange Commission. In the European Union, trading practices comply with the European Securities and Markets Authority standards. Global compliance, content aligns with internationally accepted guidelines, but laws vary by jurisdiction. Consult with a licensed professional in your area. Past performance disclaimer. Past performance is not indicative of future results. Any historical results or performance shown in this content are for informational purposes only and do not guarantee future performance. Educational content disclaimer. The information provided in this video is for educational and informational purposes only. It is not intended as investment advice, nor should it be construed as a recommendation to buy, sell, or hold any financial instrument. Always consult with a licensed financial advisor or regulatory authority in your jurisdiction before engaging in trading activities.
Alright, let's get this work done. So it's week 2, August 10th through the 14th. On the calendar, Monday is a Japanese holiday. Tuesday, no news. Wednesday, CPI. Thursday, PPI. Then retail sales on Friday with consumer sentiment and inflation expectations. So we thinking Wednesday midweek reversal would be this weekly profile. Looking at the CLT for S&P, we're about even on the commercials. It's not really one-sided. They own all the open interest too. 75% of the short open interest. Nobody's taking profits here. I don't see any closes. So from the Larry Williams perspective, the S&P CLT picture is not bullish. Commercials are net short. Large specs are net short. Small traders are heavy net long. The clean read is bearish pressure, consolidation with downside risk, unless seasonals and price action strongly contradict it. But looking from a non-commercial perspective, net position is in the red 28,013 week average, in the red 95,000 4-week change, up 15,000. So we're strongly bullish. And this is focused on the 13-week average of the non-commercials, which has been more reliable than just looking at the commercials. So here on this NASDAQ, you can see some profit taking on longs right here. They closed a lot of shorts, which could have been why we rallied so much. And they added on to longs. So this is kind of bullish here, just from, bird's eye view. Got more longs than shorts, and we own more long open interest. Non-commercials, however, are short for some reason. Probably taking profits from those earnings. NASDAQ high is moderately bullish. Commercials are net long. Plus 24,000. Large specs are net short. Minus 35,000. And Wilco is plus 7%. This points to commercial strength and potential upside reversal breakout, especially if seasonals are supportive. The only caution is that small traders are also net long, so this is not the cleanest possible contrarian bullish setup. commercial 13-week positioning. Everything is looking bearish, so it's looking like non-commercials are really taking profits, and we should go down coming into this week. So it kind of contradicts. Now here we go with gold. Zoom out a little bit. Merchants are short, they're hedging. Dealers are short, they're hedging. Management is long. It's just bullish all the way around on gold. No contradiction, no profit taking. Gold is bearish cautionary. Commercial type traders are net short, while managed money is net long, and other reportables are net long. Look course approximately -60%, showing strong commercial seller pressure. Under the Larry Williams style read, this favors consolidation or reversal risk, especially after a rally rather than a clean bullish continuation. We buy. So I'm going with this net positive 13-week average. We're stronger than the 13-week average, and we just added to it. So this is the most one-sided. This looks like they really finna take profit, and this looks like this would be the best buy for the week. So I kind of want to lean SPX because I want to buy. I don't want to be selling, not right now. Unless something in the news. So we was up higher last week. The NFP brought down the rate hike a little bit more because employment data was soft. Chance for rate hikes still hold at 55%. The word is Kevin and Trump are having a lot of phone calls, which could be a good thing if the focus is growth. Eyes on CPI this week to see if this shifts, which it's going to be interesting, which it should be up. So hikes might go down. We might be looking at holding in September, which is most likely. Earnings. So Berkshire Hathaway, that's going to be important for SPY. And then Cisco and AMAP. So Monday, Wednesday, Thursday. We got Rocket Labs and other little small cap stuff that's going to be interesting. Kind of AI-ish. Index moving earnings next week. Monday, Berkshire Hathaway, major SPY constituent. Wednesday, Cisco. Thursday, AMAT, secondary but meaningful NASDAQ and SPY names. Everything else on this week sheet is considerably smaller from an index weight standpoint. So a little bit more bearish, kind of bullish. It looks like, oh, we're taking over, but bears are still in the cash on the side, kind of the same. Pretty much heading the CPI for accredited investors sentiment 37 versus 38. There's only 1 point difference, and then 25% sitting on the side, maybe waiting for CPI. So NASDAQ. We want to watch the quality of expansion above here. If we expand above here, this was a strong if the 20-day level and lined up monthly highs, all kind of stuff. I don't think this even happened on futures, but it happened on Forex. So watching here, let's say futures wants to come rerun this level. I seen it on ICT chart and I ran, but let's say futures want to come run it. We don't close, and this would be a beautiful swing to here, really here, because CPI I'm thinking maybe play around, maybe run, come down here, but it can buys from here to go higher long term. How we get there, either higher than lower, just Trump does something over the weekend or whatever. You never know. So the quality expansion of previous week's high has to be studied. Don't want to get caught in a trap above previous week's high when the gap at previous week's low is so big. Anchor point interaction. I think the anchor point will form here, right here, fair value for buy. We kind of closed, but we still respecting this, but this will still be a type 2 expansion. Yeah, but still, we can hold this and maybe create another short-term low and run it, but restore the price alignment with fabulous earnings momentum, set up confidence, engage. Then we got NVIDIA. NVIDIA is doing the run up for earnings. I'm looking at 232. I like buy from 216. So I think the strength here is the reason we see real speed from the indexes. Anchor point in action. I think anchor point for the week will form here. So this pullback here give us that pullback on NASDAQ. Restore the price alignment. We're running up into earnings. NVIDIA always beat and they always sell off afterwards. But we engaging. Run up time. That kind of lines up with this. So that CLT was saying bearish. We could run this, sell off until we get here. And then this gets here. Then we start buying up. Here go gold, which had a phenomenal week. Made it to this week zone. I'm looking at anchor forming here, retracement, daily propulsion block. This one has been running crazy all week. If CPI gives us a pullback, the daily propulsion block would be perfect. I think the anchor point will form at it's that 4223.505. That's CFD. Store the price alignment, seasonality. Everything is not enough for a buy swing on gold. We engage in skill focus, one shot, one kill. Not taking multiple shots at my trade idea. Journaling intent, more detailed expansion study. Really getting those anchor points. Case study hunt plan, looking at the chain of custody that ICT is teaching. Risk profile 1% because of CPI week. Playing strike day Wednesday for the Wednesday midweek reversal. And that's all the chart work. All right, peace.